Hello and welcome to another episode of our Brothers Creed podcast, where we talk about motivation, experiences, and exploring the world around us. We're the Thomas Brothers. I'm Ethan.
And I'm Jared. And today we are joined by a very special guest, Terry Cook. Terry, thanks for joining us.
Thank you for having me.
Terry is a lifelong insurance guy. He's been in the industry his entire career, just about to retire in maybe the next, couple of years?
Probably 2 years, maybe 2 years at the most. I'm not going to retire. I'm going to do something different, but I'm going to retire from the corporate world. So won't be doing, working for a big company anymore.
Very good. And Terry's a lifelong friend of ours. He's known us since we were real little, and he's also got kids that are our ages. And so it's great to have him on, and he's going to share with us some experience. He's also an author and very talented, and we're going to talk today about being your own banker and some financial strategies that he's found and that his family has used generationally to build wealth, and some of his tips and strategies. So very excited to have him on. Terry, thank you. Let's go ahead and jump in.
Thank you for having me.
All right, let's do it.
You can't climb the ladder of success with your hands in the pocket.
We will not go quietly into the night.
They tell me you're a man with true grit.
I am the one who knocks.
Don't ever tell me what I can't do, ever!
That's how winning is done.
All right, Terry, thank you so much for coming on again. I think that maybe let's just take a little, just at the start, maybe talk about your background, how you got into what you do. That might be a good place to start.
Okay, well, thank you. I was raised in Washington State on a farm, southeastern Washington State. My parents are from Idaho, so pretty conservative. We had a sugar beet farm in southeastern Washington. And from a very early age, my dad taught me that there are really two types of people. There are people that get paid interest and people that pay interest to others. And he also told me there are two types of people. There are savers and spenders. And he said you always want to be the saver, and you always want to be the person that someone pays interest to. And right. So he said if you can, in your life, financially, if you can do that. And that's kind of the way he lived his life. He always was a big believer in life insurance. Quick story, when he was on his mission, his dad died, and my dad was the oldest of 8 kids. And his dad knew he was going to die before he went on his mission, and he pulled him aside on a train platform. They had train platforms back then that you got on a train. He went to like Kentucky and West Virginia and areas like that. And he said, I'm not going to be here when you get back. And my dad didn't know exactly what he meant by that. And he said, I have a brain tumor. And he said, there's 2 things I want you to know. He said, number one, you're the oldest of 8, so I want you to help, raise the rest of the 8 kids. And he said, number 2, there's a life insurance policy there that will pay the farm off, when I die. And it should be enough for you and your mom to, make a living for the family. So my dad's always been a big believer in life insurance. Taught me, about life insurance, that I've just always been one of those corny people that really, really believe in it. I carry a lot of life insurance, and I'm a big believer in it. I've taught Greg, my kids, to have a lot of life insurance. Anita knows I have a lot of life insurance, and I've told her that, when she sees my casket up the front, there's no whistling, and skipping down the aisle, that if she has to hire a cry coach, then hire a cry coach there. But
keep the cheering to a minimum.
That's please. Right. So I'm always been a believer in that. I did my 2-year mission, and then when I got back, I needed a job, and I pushed brooms for a while at BYU, and then I got into the insurance business and started selling part-time while I was going to school, knocked on doors. And when it came time to graduate, I was, making pretty good money, making more than the people that are graduating. So I decided to stay in it. And it's been a lifelong love of mine of being able to help people out and protect, the widow and the orphan. And if something happens to Dad, we can't replace Dad, but we can certainly, be a light at the end of the tunnel, or shine some light on. I've had some experiences of paying off death benefits. And so I'm a big believer in life insurance.
That's great. I imagine over your career, you've seen the life insurance products drastically changed from what they were back in the day to now, just improving so much, right?
We have. There's been a lot of changes, but also a lot of things have stayed the same. I started my career with a company called Northwestern Mutual, and they're a big whole life carrier. And so I kind of got brainwashed into whole life. And I've always had a belief in whole life. I don't think it's the only insurance product. I'm a big believer in term and universal life, but I'm a big believer in whole life, that sometime it's going to pay off. And I carry permanent life insurance on me. So it has changed a lot, but a lot of it stayed the same too.
Interesting.
Maybe for listeners out there that don't have as much experience with life insurance, could we maybe dig into each one of those, a whole life, universal, and then in a term,
Sure.
just to kind of do a very brief, simple overview of what each one of those are.
Sure. Well, term insurance is exactly what it says. It's like car insurance. It's pretty inexpensive. I tell young guys like you and Greg, load up on term. If you can, buy millions of it. And I always tell people, buy as much as the life insurance company will sell you, because if something happens to you. And but it gets very expensive when you get older. And there are a lot of radio personalities that believe that you should just have term insurance. And I get that, but to me it's kind of short-sighted and not thinking long-term. I also believe that you should have a blend of permanent insurance. Whole life is, your premiums remain level. There's also a cash value. And you said that the products have changed. And I would say over the past 20 years, they've also had some very, very good living benefits, like a chronic illness and long-term care benefits. So if something,
these are like additional insurances, right?
yeah, well, actually, they're riders. They're free riders that go on the whole life or the term, so that they not only pay a benefit when you pass away, but also pay a benefit if you get a heart attack, or if you get cancer, or there are certain,
So they'll pay out like a certain amount earlier than
yes,
okay.
yes. So that's whole life. There's also a savings element to it. I'll say there's not a big rate of return, and wasn't really built for a big rate of return. It's really supposed to be about safety. Part of your portfolio is being the safe assets. What's interesting about whole life is, do you know who buys the most of it?
Probably companies.
Banks. If you Google Tier 1 assets, TIER assets, and see where banks have that's their safe part of their portfolio. And like Bank of America, Wells Fargo, they buy billions and billions and billions of whole life insurance. And they do it for a couple of reasons. Number one, for the safety. You hardly ever hear of a life insurance company getting into trouble. I think over the past 100 years, there's been maybe one or two that have gone under, and they were taken over by other institutions. But life insurance companies, it's hard to kill a life insurance company because of the way they invest long term. And so yeah, I'm a big believer in all kinds of life insurance. I'm not, like I say, I like whole life. I like term. Universal life has a savings element to it. And there's also a variable life that has, kind of an investment asset where you can put mutual funds and things like that into it.
So one of the things you mentioned was earlier, you mentioned about the term insurance. That caught my interest. You said, load up as much term as you can. I guess this is specific to each person, but I've kind of been told that you should get about 10x your salary in term insurance. But you're saying that maybe you should just do as much as the insurance company will give you. What's the difference, or what's your thought around that?
Well, if something should happen to a father, and you use that philosophy of 10 times, your salary, and let's say your salary is $150,000 a year, that would give you like $1.5 million.
Yeah.
And that sounds like a lot of money, but if you were to invest that, where could you invest it at a real safe place? And so if you were to invest it at 5% interest, it wouldn't even replace your income. I mean, it would give your wife $75,000. So
yeah.
So I think you should probably do 20 or 30 times, but because I've seen it pay off.
Yeah, really interesting.
And it's interesting too, because working for a big company, they offer very cheap term policies. I guess it's maybe subsidized by the company or whatever it is, but I can get I think it's like 8 times or whatever it is times my my salary for like $10, less than $10 a month. I mean, it's just like something that's really low, and then obviously subsidize that with external policies as well, because if you were to get let go from that job or whatever else it might be. But that's one thing that our dad always taught us too, and kind of we've had these different we go on these like man trips every year, or not every year, but we try to, with kind of the brothers and my dad and the brother-in-laws, and last year we were sitting around the fire and we went through just these man tips, right? And we were talking about. And it's just because we were all men. I mean, I guess these are woman tips too.
Sure.
But, and that was one of the things too, is under financial independence was, have life insurance, safeguard your family against something to where, that would happen. If I were to pass away, would my wife survive and would she be okay? Yes. But do I want to leave her in a situation where she has to be worrying about that specific element in everything that she's doing?
Sure. Well, there's an interesting study done. This is when I was working with a Beneficial Life, maybe 20 years ago, but they did a study, and of the first emotion that a wife feels or experiences when her husband dies, and suddenly, and
depends on the relationship, I guess.
Well, yeah, but let's just assume that it's a good relationship. What do you think the first emotion was?
Oh no, we're screwed financially.
It's fear.
Yeah.
It's the first emotion that a spouse will feel is fear.
What am I going to do now?
What am I going to do now financially? And in a way, I think that's kind of sad. They should feel sadness and loss instead of, what am I going to do now? And so, it's always been my job to try and make it so when the husband passes away or the wife passes away, that they don't feel fear and that they feel confident. And to me,
it'll be, what am I going to buy now?
That's right. That's right. There's no. I mean, to me, when people buy life insurance, they do it for one reason, and that's because they love someone. If you don't love someone, you shouldn't buy life insurance. Yeah. And life insurance is bought because you love someone.
This is kind of a weird question. Are you familiar with like final expense insurance?
I am.
And like pre-planning and stuff like that?
Yeah.
What's your opinion on that?
Well, final expenses is usually purchased from people that don't have a lot of life insurance, and they're trying to pre-plan their funeral, and usually they've waited until it's too late to get normal kinds of life insurance. It's a big industry because most people put off planning, and I think it's a good thing to do that. I mean, there's some good companies and bad companies out there, just like there is with anything. But for the most part, it's for people that have put off and they're paying a lot more. And what I tell people, that the time to plan is now. Like your age, Greg's age. I'm getting ready to convert some of Greg's term into whole life. And the time to plan is now, so that you still have that amount of life insurance, when you pass away. And so term is like when you have your kids at home, you need to load up on it. Then maybe when your kids are, my kids' age, some of the term drops off. I have term. I mean, I think I've got $1 million policy that it was a 30-year term that I bought. And I think it'll drop off when I reach 74 or 75 or something like that. And it's so cheap that I keep it. But it'll drop off, and then I still have a lot of permanent insurance.
Yeah. What do you recommend around like spousal and children insurance?
Okay. I think that we underestimate, what a spouse is worth.
Yeah, totally.
And especially in your situations, because I know your spouses and how valuable they are.
Indeed.
And, if something were to happen to them, and obviously they're probably not the main breadwinners, but taking care of the children. And so I say load up on the spouse too with some insurance. And if I was going to say, maybe get a couple of million a term and maybe $200,000 or $400,000 of whole life, so that you have that when you don't have to buy final expense, at some time.
Mm-hmm. Yeah. I asked that final expense question. There's lots of differing opinions across the industry about that. Actually, that was my first job out of college. My wife and I, we moved to California, and I worked for a life insurance company that sold majority final expense insurance. And I was a licensed insurance agent for them. Life insurance. And it was really interesting. And I saw that a lot. There were a lot of people that they got, maybe to that point, or, I would say 95% of all the people that I saw were not, they were not sick or terminal or whatever else to think about funeral expenses. But it was something that they didn't want to have to worry about. I firsthand saw the benefit potentially of final expense insurance, but life insurance in general in that industry.
Sure. Well, I think it's important to plan ahead, because final expense can be, you're paying a lot of money for not a lot of death benefit. And the other thing my dad told me, going back to my dad, is, do what rich people do. Find what, and rich people buy a lot of life insurance. Rich people buy a lot of whole life insurance. And they've done studies on who buys whole life insurance, permanent insurance. And it's the most educated, the most, the rich. And a lot of businesses have been, started that way, like, Kentucky Fried Chicken and Disney World. And, they were able to borrow from their life insurance to fund their businesses.
Is that maybe because it's more expensive and maybe term is cheaper, so you have people who aren't as to do or as wealthy that they're like, well, I can't afford whole life, so I go term? Or
I think it's a combination of not thinking ahead and planning ahead, and it is more, when you say expensive, it's more of a disciplined approach. And it's really where you put your money, because I don't really take a look at what you pay for whole life insurance as a premium. A lot of people take a look at, insurance like car insurance or homeowners insurance like it's a premium. And when I know your dad has some permanent insurance, because he bought some from me, some term insurance for me for a while. And I take a look at permanent, whole life, universal life, variable life. I take, when you make a payment, when I make a payment to mine, I look at it more like a deposit than I do a premium payment, because I know all the money that I'm putting into it, I'm getting back, and then I'm saving. And so I don't really look at it as a premium payment. I look at it more as a deposit, like in a bank.
Interesting. So I think that perfectly ties us in with kind of the portion about this book that you're writing, which is the Mortgage and the Beast. Is that what it's called?
That's right. That's right.
And so this concept, and I've read a little bit of a first draft of your book, which is excellent, by the way. And it talks about just the mortgage industry. You talk about that and how the cost of interest that people pay over their lifetime. I think you said it was what, $600,000.
$600,000 according to AARP.
Yeah, over their lifetime, people will pay an interest.
Yeah.
And so your strategy and what you kind of talk about in this book that you're writing is about how you've been able to, in your own life, and then also in advising others, how to work around that by using an insurance policy.
Sure.
So can you talk about that?
Yeah. Like you said, according to AARP, every person that comes into America will pay, like $600,000 of interest over their lifetime. And when you pay interest, it's money that you never get back. It's like, taking a match to it and burning it up. You can never use it again. And on top of that, you also lose what that money would buy, mainly pleasure, like trips around the world. I mean, you think $600,000, you could take your family on some nice vacations. And so I really refer to this as the worldview of money, that we're raised here, we go to school, we take loans out, we get a mortgage, we buy cars on time, we get second mortgages, we run up our credit cards, and the average homeowner or married couple in America, if you can believe this, they pay as high as 30% of their income in interest.
Wow.
And so if you take a look at just a $300,000 mortgage, you'll pay almost $300,000 of interest if you pay on that for 30 years. And so in the book that I'm writing, I point out that debt is not bad. Mortgages are not bad. They're an awesome blessing that we have in our lives to be able to have a beautiful home. But they're also a trap and a beast, and that is the amount of interest that you'll pay if you keep it for 30 years. And usually what banks do is I get cards in the mail almost daily that says refinance, refinance, refinance. And so, they do that all over again to a lower mortgage, and
they keep churning you.
They keep on churning.
Paying
That's right.
Most of your payment to interest.
That's right. And so most financial advisors, they're about rate of return. And, hey, I can get you a good rate of return. I can get you a great rate of return. Well, let's say that an advisor can get you like an 8 to 10% rate of return. What good is that if you're spending 30% of your income in interest? I mean, that's like, 10% coming in and 30% going out the back door, or being in a boat and, 30 gallons coming in and you're scooping out 10. So I say, try to get rid of that interest, going back to what my dad gave, and my dad was just, non-college educated and just a farm boy from Idaho, is that try to get away from, get a mortgage is a great blessing, but then try and get out of it. And in my opinion, the best way, and it's about math, and I talk about that in my book, is that, there's really 3 ways you can do. You can throw more money at it, number one. That's kind of the Dave Ramsey way. Yeah. And this is a good, it's not a bad way. And the second way is to refinance, and that's okay too. And the third way, I think, is to put that $300 or $400 a month into a permanent whole life policy. And the reason why is that you have several benefits. Number one, safety. Number two, you have a death benefit, so that if something happens, the home is paid off. So you have that. Number three, and this goes to the living benefits. If you get a heart attack, you get laid off from work. You have an emergency fund, but also, a fund there that would help pay the mortgage if something happened to you in your health. But it also, Ethan, goes back to what you're saying, is that the biggest threat that we have, that I have, that your dad has, that you'll have in 30 years, 40 years, is when you turn, 65 and you get gray hair like I have, you have the threat of long-term care and, the possibility of not being able to take care of yourself. My wife, both of her parents were in a long-term care facility at $8,000 or $9,000 a month, and that's not paid by Medicare. It's not paid. That's a big threat that you have, and so the time to prepare for that is now. And so one of the big benefits of doing your mortgage that way is you pay it off when your mortgage reaches what your cash value is in your policy. You take money out of your policy, you pay your home off, and then replenish that policy, paying yourself. So let's say that you're paying $400 a month for this whole life policy. And let's say it's a 30-year mortgage, $300,000. So in the 20th year, you'll have enough money in your policy to pay your home off early. So you take the money out of your policy, you borrow against it. It's your money anyway. And then what you do for the rest of the 10 years is you replenish that policy. And in essence, you're becoming kind of your own banker, because instead of paying the bank, you're paying yourself. And so, if you take a look at a regular 30-year mortgage, 360 months, 30 years, you've paid close to $600,000 for that home because most of it's been interest. But here you can save probably $150,000 in interest by paying it off in the 20th year. And then by taking that mortgage payment, because you were used to paying that to the bank, pay it to yourself now, going back to, pay yourself or, pay someone else. And then you have a large chunk of money at age 65 or at the end of your 30-year mortgage, $200,000 or $300,000 in there, but also some other long-term care benefits there. So that's why I believe in it, because, and in my book that I'm writing, and I hope to get it approved for by our home office, but in the book that I'm writing, it comes down to just math. It comes down to just math.
So let me ask you some questions around that, because I think that's so interesting. So when you borrow from your policy, you're paying yourself interest right, for the money that you borrow out. How much interest, like what kind of an interest rate would you borrow out of your policy from?
Well, what you're doing is when you borrow, first of all, on a whole life policy, you don't borrow from the policy, you borrow against the policy.
Okay, from your cash value.
The cash value. You don't borrow from you can't take cash value out of a whole life policy. The life insurance company is using that as collateral. And that's important to understand because your policy is still growing and still getting interest because you haven't borrowed from it, you've borrowed against it. So the insurance company is going to...
Against it, as in if someone passed away, you would just get less life insurance?
You get life. When I say against it, let's say that you have $150,000 of cash value in your life insurance policy and you want to pay your home off. You don't take money from your life insurance company, from the life insurance, your policy, but you use that as collateral.
Okay.
And the company, life insurance company, gives you a loan from the general funds of the company, and they charge you interest. So you're paying interest just like you would, but remember, you still are gaining interest inside your policy. So I don't know if it's ever a wash, but you're still getting uninterrupted interest inside your policy.
Now, is the loan that they give you amortized like a mortgage loan, or is it just like a simple interest?
A lot of companies do it differently. Most of them do the simple interest, but my philosophy is that you should pay it back. Really, what you're doing is putting money back into the policy as soon as you can, so that you're not paying that interest. And so, if you're using your mortgage payment to pay that back, what you were paying, it should be paid back in, well before the original 30-year mortgage.
You were saying like $300 a month you're paying into the policy. Well, then if your mortgage is, I don't know, $2,000 a month, if you're no longer paying your mortgage, but you can pay that $2,000 plus the $300 into
that's right.
It'll
pay it back.
Pay
that's
it back
right.
quickly.
That's right.
Well, like say you're paying $300 a month into your policy, and that's just the required payment per month to maintain that policy. And then so if you take out a loan, you still have to maintain the $300 a month, and then but you're saying reallocate your mortgage, so it's not necessarily stacking the $300 plus the $2,000 because the $300 is required, right?
$300
and that's
required.
just going to maintain your policy.
That's right.
And then the $2,000 would go back to pay off the loan which you
That's
got from the
correct.
insurance
That's
company.
correct. That's
so
correct.
I guess a skeptic would say, aren't you just, you're taking a loan out either way, whether it's from the insurance company or from the bank. What's the difference?
There's not a big difference. There's really no difference. The big difference here is that having the life insurance policy is that your money inside the life insurance policy is still growing uninterrupted. So you still have that compounding interest growing inside your policy. And so when you pay that back, what you're doing is you're cutting back on the interest that you would pay that the insurance company is paying you. And obviously we want to get away from not, paying any interest. And there's an interest charge that goes with that. But remember that you're also gaining interest inside your policy. So you're paying some interest, but you're also gaining interest inside your policy.
Like, and I think in your book it said generally between 4 to 5% is historically what.
That's right.
That internal rate of return.
That's right.
On your.
I think as well, kind of what you were saying is you also have those riders on a policy that protect you as well. Is that true? I mean,
to me, that's a good life insurance policy is like a Swiss Army knife. It does more than just one thing. And to me, legacy, but also the living benefits are just huge. And if we take the first two examples of just throwing money to your mortgage and paying it off by just paying the mortgage company, extra money every month, that's okay. But what good does that do if you pay your home off and at age 65 or 30 years down the road, you need long-term care? So you have your home at risk still. And most experts will say that husband and wife together have as much as $700,000 or $800,000 at risk of having to go into a long-term care facility. And so to me, the life insurance policy covers that with the living benefits, and that's huge.
So it is similar kind of to what you were saying, Jared. It is similar to kind of taking a loan from the bank if you were to think of it that way, but the bank's not going to offer you other things as
That's
well.
right. That's
in
right.
addition to,
And that's really the kicker with the whole plan is that these other benefits are so great that really you're paying interest either way, paying off your house, but with the insurance policy, you're able to get all these additional benefits that the bank is not going to offer you.
And there's some tax benefits too, because you can take money from your life insurance policy and have tax-free, tax-favored income, kind of like a bond, and have a stream of income.
Within retirement,
In
you
retirement,
can pull out from your cash value.
You can pull out from your cash value and have $1,000, $2,000, $3,000 a month coming in tax-free if it's designed right. And so the tax benefits are enormous as well.
And insurance policies are exempt from estate tax. Is that correct? Or
they are if they're titled right. Usually, I mean, I don't want to get into tax law, but a lot of people use insurance trusts and things like that. But I think that you should own your own life insurance policy. Your wife should own it on you, or someone else should own your policy on you.
now, do you own, or would you, when you talk to folks, would you recommend building like a family trust and putting everything in the name of a family trust and having that policy in like the family's name, or do it as an individual level?
I like trusts. When your assets get up to a certain amount, I think you're probably talking millions of dollars. The government right now, we've lived in some times right now where estate taxes are really nothing that really a lot of people had to worry about unless you were the ultra wealthy.
Yeah.
But the government's looking for money, and they're talking about maybe taking that down to maybe $3 or $4 million. And if that's the case, then if your life insurance isn't designed right, then you're going to you could be looking at an estate tax.
But couldn't they just change the laws about the life insurance to make that not exempt anymore?
They could, and there's talk about that. Right now, insurance law or insurance funds cash value is under Section 7702 of the IRS code, and that makes them tax deferred or tax favored. And the government's looking for money. They're looking for money, and we're scared. They're looking for money. We think they'll grandfather it in, but there are European countries where they tax the buildup of life insurance policy in European countries, and some European countries they even tax the death benefit. So
wow, crazy.
Yeah.
So we've kind of talked about what some of these strategies are and different things like that. How have you used it in your life? I know that you have several different properties that you've lived in throughout the years, and that you've moved and kept those properties and paid them off. Have you used this strategy for that?
I have, and I've also used another strategy where, I've always tried to buy a piece of real estate in a good school district in a good area. I've tried to keep them up, and I've also, going back to my dad, tried to have other people pay me interest. And so usually when I thought the rent would equal what my payment was, then I would have, rent them out for what the payment is. And so it was in essence doing that. And I would use some life insurance funds to pay them off quicker and faster than pay it back. But again, if you can have other people pay you interest, rent, whatever it is, and the more people you can have that, and between your age and my age, you think that's a long time, but it really, over this period of time, we've been able to pay, properties off and be able to have a lot of rental income coming in. That's been a blessing to our family.
So let's say, back when you were in the heat of doing this, you're living in a house and you say, okay, we're at the point where I think, we've paid down enough on our mortgage to where someone renting here would be able to basically cover this. We'd make an extra couple bucks a month. At that point, did you move, or did you wait until you paid off the entire house and then you're just like, okay, kids are in a good place, now let's move?
I usually moved before it was paid off, where I had a payment, and I would let the rent make the payment. And most of the time it was, $200 or $300, $400 more than what the payment was. But I'm a believer in real estate too. It's been, and there were years, that Anita and I would look at each other because they're a hassle. I mean, real estate's a hassle. I mean, you've got air conditioning going out. In fact, I had an air conditioner go out Friday with the heat coming on. And I have management companies that run that for me. But, you have to, first of all, ask yourself, can you handle that mentally and emotionally? But I'm a big believer in more than just life insurance. I'm a big believer in, doing real estate part-time. And, Charlotte was kind of a down market for a long time. I mean, it was kind of a down, I'd buy a home, some of these homes I bought for, a couple $100,000, and for a lot of years they stayed at a couple $100,000. I thought, geez, is this ever going to go up?
And it went up.
It went up. That's right.
Yeah, especially recently.
That's right. And so, I've had some money, some properties where you've been able to more than double your income, and just patience, just patience, just patience, and it doesn't happen overnight. Year after year, sometimes you scratch your head and say, boy, is this really worth it? And I can say that, getting close to retirement, that it'll be a big blessing. Greg went to dental school. We were able to, buy him a place in Chicago, and we used money, to pay for his rent there and help him out that way. So, it's been a blessing to be able to help the family out.
Yeah. Well, when you were talking about all the responsibility that comes with this, a saying comes to mind that heavy is the head that wears the crown, right?
That's right. That's right.
And so with with all that responsibility, I mean, if you're going to be the head honcho and be making all this money with all these real estate deals, you're going to have that responsibility. And so it comes with the territory.
It is, and it is a hassle. It's a hassle, and there's no getting around it. And you try and keep the properties up. There's still things that go wrong with them, and for me, I have pretty good management companies that take care of a lot of that for me, and you pay them, 10% or 8%, but it's still a hassle.
So, let's look back into the past, right? Jared and I are both in our 30s. So think back to your 30s. You've probably got young kids.
Full head of hair.
Full head of hair, that's right. Yeah.
Yeah, strong as an ox, right?
No, probably not strong as you guys. But.
What did that look like? I mean, what did your strategy look like then? Were you already in the throes of all of this, or were you trying to figure everything out, or and I guess that's kind of brought you to today. But what did that look like for you in your 30s?
Being in the insurance business, I always tried to take a long-term view of it, and more of a marathon as opposed to a sprint. And there are times, good years, bad years. We've been very blessed. I've made, a decent income, but not super wealthy income. But, to me, you just plan out where you want to be. And I think in my book, in one of the chapters, when Greg graduated from high school, you kind of plan, from the end, from the beginning. So, where do you guys want to be at 65? And that's kind of how I did it, thinking that, okay, I like real estate. I like, I'm not a huge real estate investor, but I like, dabbling in it. That's really all I've done is dabble in it. But, and just make goals and stick with them. And, have spouses. Anita's been, it's not fun to move. We moved here, and it's not fun to, move, but she's been on board, and she helps take care of some of the maintenance. So, it's just day in, day out, and, paying the premiums on our life insurance, making the mortgage payments. I'm a big believer in savings. I've worked for a company. I've always saved 15% of my 401k, and that's built up a lot. And I figure that if you don't see it, and a lot of people don't like 401ks, but I'm kind of a spender naturally. So if I don't see it, I don't spend it. So a long time ago, I'm gonna save this amount of money, and it's worked out. I can't say that I'm super wealthy, but we're comfortable, and we've been able to help out our family.
I like that kind of focus on what you want in the future, and then set goals to get there, and that it's not going to happen this month to next month. It's kind of a time game, and I think a lot of it, the market is slow to rise and different things like that, and it's not just all a one hit wonder type
Sure.
thing. And diversify in several different things, like
That's
you were
right.
saying, savings and real estate and life insurance and.
Yeah, I was gonna say one thing that I think that the perspective that you bring which is so good is that long term perspective. And when you're talking about life insurance, your brain is steeped in long term perspective. And what's the end game here? And one thing I've been thinking about recently is like, okay, I'm like 33. I'm like, okay, 30 years ago, what did Charlotte look like? And it was like, where we live, my parents and where you live, that was the edge of Charlotte.
It was.
And there was fields and woods
That's
beyond
right.
that.
No 485 where we were at. Yeah.
No
And-
Ballantine, no
no,
anything.
And now that's like, that is Charlotte.
That's right.
And now I live on the fringes of Charlotte. Now this is becoming like
That's right.
a huge city. So
That's
it's like,
right.
where can I put my money and invest now so that 30 years from now, imagine if you had gone and just bought up a bunch of houses 30 years ago and you're just like, obviously you had the means to do that, but I'm trying to think long term and like, where can I invest now so that in 30 years, is this going to be a good spot to have a house or a home or rental?
Yeah, I think I'm a big believer in real estate. I think it's, even when it wasn't going up, I took the long-term view of it, that at some time it'll take off. And I think, finding good areas in real estate, taking care of the real estate, making sure you're on top of everything is, I replace roofs, I, put more money into them. And so taking the long-term view of that, but also, I invest in other things. I have REITs that I invest in. I still have some money in stocks. I have some money in mutual funds. So I'm not just a believer.
Yeah.
I have other, I diversify, in that as well.
Yeah, one thing I wanted to ask you about it, and we talked about the government looking for money, right? Really, there's only two ways that the government can pay off the national debt and get this money. One is through inflation, and two is through taxation.
That's right.
And so I think that we're going to see, and what they just increased with all the stimulus they've been paying out, they've increased the money supply by like 25%.
Yeah.
So it's like inflation is a serious concern I think people should be having. But one of my concerns is if I'm putting a lot of my money into an insurance policy, and let's say it's earning 4 to 5% a year, I would have the concern that 4 to 5% is basically what the inflation rate is. So basically, I wouldn't be making anything.
Sure.
So what are your? If someone had that concern, what would you say to that?
Well, first of all, in every portfolio, in my opinion, you need to have safe money. And in my opinion, we're also living in unprecedented times. Our country has never been, $26 trillion in debt. And the way the worldview looks at the stock market is they go back to 1900 or 1920 and said if you would invest in the stock market at this point, you'd have an 8-9% rate of return. Well, it wasn't a world economy back then. A lot of things are different now. And so what I say is, life insurance and real estate's not the only thing. But I've had my money in the stock market in 2008 and 2001. And both of those times I took like a 40%, hit in that. And I would have loved to have had a 2 or 3% rate of return back then. I would have just died to be able to have. And I was scratching my head thinking, why didn't I just have my money in a safe account? So sometimes the rate of return is the money that you're not losing. Okay.
Yeah.
And that you should have money. And again, getting back to where do the smartest people in the world work? Probably at the banks, Ivy League educated people. And where do they put their safe money? It's in life insurance. Just Google it. So should you have all of it in there? No. So, I diversify real estate. I have, certainly don't want to come across as super wealthy or anything, but I've diversified and have it in a lot of different places. But I'm a big believer in safe money, so that if something happens, you got safe money there.
Very good.
I like that. And you've had years of experience to kind of build that portfolio. Obviously, someone who is kind of at the starting point, of their building their own portfolio or their own, retirement plan or whatever it may be. I think the end goal is kind of like what you said, is to, live comfortably and be able to help others out.
That's right.
Yeah, this has been so insightful and very interesting. I think that when your book comes out, we definitely like to blast it out to our on our Instagram page and let our listeners know about it.
Is there a time frame? Potentially?
Well, I've pretty much got it finished. I'm tweaking it. Jared's helped me, giving me some reviews on that. I still work, for Western Southern, an insurance company, and I'm an officer of the company, and so I have to have it approved for by compliance and legal. And so I'm trying to finish it up and submit it to them, and then we'll see what happens. Maybe they'll approve it, maybe they won't. So
Great.
It might have to be after I retire. I don't know, but
so maybe definitely in the next year or two.
that's the plan. That's the plan.
Great. Well, I know that you also mentioned that you have some ideas in mind of things that you're going to do during retirement, and so maybe we'll have to have you back on to
Love to
talk
Love
about
to.
some of
Love
those
to.
some of those things, and with all the wisdom that you have, it'd be great to share that with those
Would love to.
who are eager to hear it.
Would love to.
So, at the end of our podcast here, what we usually do is we talk about a personal creed. We talk about a creed as a set of beliefs or principles that guide your actions in your life. Would you be able to share a piece of your personal creed with us?
Well, I think in my book that business is really third. What we do, and family and God. I don't mean to. You probably get a lot of people that do that, but my family's always been, extremely important to me, and I've always said it's God first, or they're right there together. And honesty. My dad taught me honesty, that you never take advantage of anyone, that you always try and treat people like you'd want to be treated, and then just be grateful for what you have, and also never compare yourself to others, financially or what you have. That's one of the first big mistakes you can make. And it's also, when you start comparing and wishing you had something that other people have, like a nicer home or a nicer car, you also break the first commandment of the 10 commandments, and that's coveting, just be thankful for what you have. And it's hard, especially, for you young guys. You look around, you see people probably, driving a nice sports car and living in a bigger home, and you think, man, I just, but just be grateful for what you have. I did the same thing. I always wanted more, and then just take a look at the long view of it, and save, save for your family. We were able to get Greg and Angela through undergrad without any bills. We were able to pay for that, and that was what was important. So just priorities. Take care of your family. Keep your priorities in order. Don't look at what others have. Just look at what you have. Be grateful for what you have, because you're probably in the 1% of the world today. Probably the upper 1% of blessings that you have. And sometimes we start feeling bad because we don't have as much as the next guy. And if you can stay away from that, that's a bad habit to get into.
Yeah, be patient.
That's right.
Be patient
and grateful.
And grateful. I like that. Yeah, we did an episode on gratitude, and I think that's it's an attitude of gratitude is something to definitely have. I really like that. And doing what you can to one thing that you said, and kind of being in a situation financially where you could help prepare the future for your children as well.
That's right.
That's one thing that potentially life insurance has a possibility of doing, if done right, is preparing the way for a legacy for your children.
That's right.
I saw that when I was doing insurance in California. There was a lot of people that I talked to that they said, my father passed away and he left me, $2 million in his life insurance policy, and my life has completely changed.
Sure.
Not that it's all about the money, but to be able to leave a legacy to those that come behind you, I think is a huge deal.
My dad left us some money. There's 5 of us, and back in the 70s, it was $400,000 or $500,000, which was a lot back then. But it's been a real blessing, and we're going to use it to help the grandkids and help for their educations. And it wasn't, to carry on the legacy that we have.
Yeah. And I mean, legacy as far as well, your father had left you some of that money, but as well, I mean, you have shared lots of those nuggets of advice that he gave you as well. It's almost like this emotional legacy, this ideology that you've carried with you throughout your life that wasn't maybe financial, but it has helped guide you financially.
Just common sense, really. Just values.
Awesome.
Excellent. I think that one thing that maybe would be important though in our whole conversation is if someone is really interested and they say, you know what, I actually do need to get a policy, or I do need to understand more about this. Where should they go?
Well, I'm not licensed, unfortunately. I mean, I am licensed, but I'm not allowed to sell. But I would find, you know, I know some advisors, you know, around, but you know, find an advisor that is like-minded to what you are. So many of the advisors now are about rate of return, and rate of return is important. I like rate of return. I chase rate of return too, but it's not the most important. And you know, find an advisor that's balanced, and they're out there. They're out there.
Any companies specifically, or they all generally have the same products and
you know,
stuff? Just depends on the advisor.
I'm a big believer in highly rated companies. That's just me. I'm a big believer in A+ companies. I've always tried to be associated with the best. I know you work for a highly rated company. And in fact, your company came up, we had a webinar today. We announced 2020 results, and they said our reserves are equal to what TIACREF is, and they're the best in the industry, you know. So you know, always highly rated companies going to be around, companies with track history, A+, AAA, high Comdex ratings. That's what I like.
Very good. Thank you. I think that might help direct some people too. They feel inspired by all that you've been saying. They're like, okay, I actually do need to do this, and this is the motivation I needed. So I want to give some people some ideas of where to go look. Cause,
sure, I can guide them in the right way.
That'd be great. Well, you know, I just want to say at the end here, thank you so much for coming.
Thank you for having me. Thank you. Good to see you guys.
Really appreciate it.
Good to see you guys. Love you guys.
Thank you.
You do appreciate
You do
it.
appreciate that. And for all of our listeners out there, you can follow us at brothers.creed, a.brothers.creed on Instagram. And let's build our creed together.
All right, let's do it. Thanks, Terry.
Thank you very much.